What's going on, ladies and gentlemen? Welcome to class today. We're going to teach you everything that you need to know about making your company bankable. And so what does bankable mean? That means banks will loan you money. People will take risk on you. Not people, banks will take risk on you. They'll want to capitalize your business and give you some money to where you can grow and expand. That's what you're going to learn today. First off, if you're watching this live, which not everyone, we're going to be sending out the replay, so not everyone will be watching this live. But if you're watching this live, I have a lady named Taylor Rivas that is in the chat. She works directly with me at Closer Capital. Taylor will answer any of your questions. So you, at any point, if you have a question, just put it in the chat, and Taylor will be more than happy to answer those questions for you. She has got over a decade of lending experience in banking, in the banking industry. She is amazing. She is my right-hand woe man at Closer Capital. She is the originator of all of our loans and puts together all the financial stuff there. So whatever she says is as good as if I said it. So any questions you have as we go through this stuff, just put them in the chat, and you will see Taylor reach out to you and answer those questions for you, because it's probably going to take me quite a while to get through all of this, and we are not going to have time for Q&A at the end, and you'll probably forget your questions and everything else, so Taylor will be answering those. So next thing that I want to go over is that we will be sending the replay out. We want you on here live, obviously, but we will be sending the replay out. You can forward that to your friends, your business partners, whoever as well. We appreciate you attending today. Look, I don't have a course for sale on this. I'm not going to sell you a program or a mastermind or a live event. I just know that the things that I'm about to teach you weren't taught to me in school. They weren't taught to a lot of my even banker friends in college. They aren't taught to the mainstream channels like YouTube. And the people that do teach this stuff want an immense amount of money for it, to learn it, because it costs them a lot of money to learn it as well. And I just wanted to do this as a way to give back to the community. In all transparency, if you hear something that you like, if there is something that I say that you have questions about or that you'd like to take advantage of, then all I'm doing is giving you value for the chance for Closer Capital to own your business, to earn your business rather, in the event that you need to borrow money or you like some of the stuff. Now, we don't do all of the different financial setups I'm about to show you, but there are several that we do. And if there's a way that we can help you or a friend or anybody else, that's my only mission with this, is to give back and maybe take a chance at earning your business in the future when you need money. So let's get started. We'll bring up the slides here. It's how to borrow capital for your business, no matter what business you're in. You see, right now I read a statistic that 69% of all businesses cannot borrow money from a bank or a lender or even private money. And there's a very specific reason for that. It's because most people don't know how to set their business up for success. Now, for me personally, I've been borrowing money in my business name for cars since 2016. This building that I operate out of here, this 22,000 square foot and $10 million, I bought it in a brand new business's name. Like, this business didn't have any credit. It was an LLC that I started on a Thursday and closed a month later on this building. So I've got personally 20 plus years in the financial industry. I started off as a mortgage loan officer, and I'm going to be teaching a lot about mortgages this afternoon as well. And now I'm currently a business lender, which means we loan money to businesses, and we are the go-between for banks and private money and a lot of other variants out there. So I've done over $500 million in real estate and business funding and transactions in those 20 years. So I've got a vast amount of experience. Now, there might be some financial license experts here, and I'm going to be saying a lot of stuff outside of the box, so don't shoot me down, because I'm only going to speak from experience, and maybe just because your bank or your institution doesn't do some of this stuff doesn't mean that I haven't been able to pull it off and make it work, and that's what I'm here for, to give to you. So let's get started here. First off, the types of loans that are available to a business. Let's talk about these for a minute. We've got the SBA 7A loan. So that's the kind of loan that you go to the Small Business Administration, the SBA. That's the kind of loan where if you're going to buy a business or if you're going to start a business, that's what you're going to apply for. In most cases, they offer a wide variety of other loans too, but the traditional, most common way is an SBA 7A loan. There's also cash advance. That's where a bank or a lender looks at the amount of deposits that go into your bank account, and they look at the amount of money you show a profit on at the end of the year, and they make a decision based on those profits and those amount of deposits, and they loan you money up front with interest rate attached to it. There's equipment financing. A lot of you are familiar with Section 178 and Section 179 of the IRS tax code, where you go buy work trucks or a tractor or any kind of equipment. A lot of people think equipment has to be a bulldozer or an excavator or a work truck, but really and truthfully, equipment can be furnitures. It can be this Vibe board. It can be computers. It can be anything that is actual equipment for your business. We had to put in about a $500,000 air conditioning system here. That's equipment. We could have got a loan against that if we needed to. So there's a lot of things that people just think equipment is like tractors and trucks, but there are a lot of things that actually fit inside of that box. Then there's factoring. That's where a company says, okay, you've got a residual recurring model for your clients. For example, in our Apex program, a lot of people pay us monthly. It's a year-long commitment, but a lot of people pay us monthly. We could turn around and get about a 75 to 80% loan against those future residuals if we wanted to get a factoring loan. So if you're in a business that maybe you get residual income, whatever it is you sell, people make monthly payments, you do self-financing for your customers, whatever that thing is, you can actually turn around and sell those notes to somebody besides J.G. Wentworth. Call 877-CASH now, right? You can sell that shit to some. That's good fucking marketing right there, ladies and gentlemen. When everybody knows who that person is and what their theme song and phone number is, that's good marketing. That's the ultimate jingle, 877-CASH now, right? But don't call them. They're gonna give you like 50 or 40 or 30% of your notes for factoring. Then there are business credit cards. You know, in my wallet here, and no, you can't have my mother's maiden name or my date of birth or any of that. But in my wallet here, I have an American Express that my business stuff goes on. It actually says Break Free Academy, which is the parent company of Apex right here. And then I have an American Express that has my personal name and no business on, right? Because you always want to separate personal finances from business finances. This business credit card right now probably has $200,000 in charges just this month on it, whereas my personal credit card here probably has about $10,000 in charges. I pretty much put my whole life on American Express, right? Matter of fact, that's how I founded these companies and built them up into 8- and 9-figure companies, is just simply through using American Express, because I didn't know how to get business loans when I got started, probably like you. But the American Express business card does not report on my credit. It does not affect, it's not tied to my social security number on my credit reports or any of that, but this personal credit card's on there every single month. What are the benefits of business versus personal? Well, I have an 840 credit score, okay? And the reason why I tell you this is on that credit score, I have my personal mortgage, a few credit cards that I pay off monthly, Dave Ramsey, if you're watching, that I don't carry a balance on, that I pay off monthly. I have 0 car payments, 0 student loan payments, and I've been making a history of paying mortgages, and prior to having paid off cars, paying installment loans on cars and things like that for a very long time, okay? If I don't pay this American Express business card, it's not going to go 30 days late on my credit. If I don't pay, my Porsche is financed in a business loan through the company. If I go 30 days late on that Porsche, it's not going to affect my personal credit. Now, they might come after me civilly in court and sue me and put a judgment on me personally because I guaranteed it, but it doesn't report on my credit, meaning if I go apply for a mortgage somewhere or if I go apply for a loan personally, I don't have to list those as obligations because they're not obligations to me personally, they're obligations to the company that I own. Then there is a line of credit, right? That's where, for example, right now we're going through the process on this building. There's a tremendous amount of equity in this building. We are putting a line of credit on this building so that when I need money, I've got low interest capital that I can go out and use. So for example, we're throwing MDM, which costs us millions of dollars to throw every single year. If I needed the money, I could use the money against the line of credit on my building. And again, that doesn't affect me. It's secured by that new LLC. Well, it's 2 years old now, but that new LLC that I started and this building, not by me personally. And then there's business real estate loans. I had a friend yesterday, and she hits me up. She says, I want to buy a home for my mother in my LLC's name. And I said, awesome, we can do that for you. I don't do personal credit cards. Closer Capital, we don't do personal mortgages. We don't deal with the consumer. We are a business-to-business lender, but real estate business-to-business lending, whether it's a commercial building like this, or whether it's an apartment complex, or whether it's a single-family home, or even a condo or trailer home that you want to put in a business name, we do those real estate loans as well. So that's pretty much the 7 types of business loans that are readily available. Are there other stuff that's out there? Absolutely. We could be here all day for as long as you had the time to spend learning about all this stuff. But I want to break down the main things so that you can maintain the main things for your business, okay? So what is being bankable? Being bankable is a business that you've built that the banks will loan money against. Nothing more, nothing less. 69% of all businesses are non-bankable. That means that they are not able, the bank is not willing to take a risk on them. They're not able to borrow money. They're not able to get capital. And you might be sitting there going, shit, I wonder if I'm bankable. That's what this is about. If you're not bankable now, I'm going to teach you the steps to where you can be bankable. Now listen, some of you might be Dave Ramsey fans, and I love Dave Ramsey. I watch his show. I think he's great. I've learned a lot from him. But there are 2 types of debt. There is consumer debt, which if I didn't pay off my credit cards every month and I was making minimum payments, that stuff might ultimately catch up to me, cause me to have to maybe file bankruptcy or ruin my credit and everything else. And then there is business debt, which you use business debt, being bankable, use business debt to grow and leverage. If the bank gives you a 20% interest rate on a credit card or a cash advance or something of that nature, then you can go out there, and if you can sell a product at 25, 35, 40% margin, which is where a lot of companies operate, then you can actually make money off of that debt. If you can leverage OPP, other people's money, or what I like, or OPM, other people's money. So you down with OPP, right? Or what I like is OBM, other banks' money, right? Because I would feel bad if I owed an individual person money and I couldn't pay them. But if I can't pay the bank, which has never happened to me, but I really wouldn't give a fuck. They're the bank. They got more money. They're leveraging the shit 10 to 1 anyway, right? So today I'm going to help you become bankable by explaining the loans, what you need to do to put yourself in a position to be able to get these type of loans, how they work, what the interest rate expectations is. And listen, a lot of this is going to be generalization because everything that you do is going to be unique to you. Every business is unique. Every industry is unique. Every person's portfolio of how they're evaluated based on their credit scores, their deposits, their profits, their history, all of those things are factors in what comes in interest rate. So take what I'm saying as a high level view of all of this. And if you want to dig into the nuts and bolts of it and figure out exactly where you're at, that's what Taylor is in the chat for, and that's what Closer Capital is for, okay? So first, let's talk about an SBA 7A loan. Typically, to get one of these are probably the easiest SBA loans to get. Typically, to get one of these, there are a few things that you have to do, right? They're most likely going to give you a 90% loan to purchase, okay? So that means, if we go over here to the Vibe board, that means if you're going to buy a business for, here, we'll just make this very, very simple so we don't scare people with numbers. If you're going to buy a business for $100,000, the bank is going to loan you $90,000 up to, right? You may only qualify for 80%, 70%, but they go up to 90%. So the bank is going to price loan, which makes this 90% what they call LTV, which is loan to value. Now, there's a couple things about loan to value that you've got to understand, whether you're taking an SBA 7A loan or you're buying real estate. Loan to value doesn't, you might be going and buying a business for $100,000 that's actually worth $500,000. Now, they're not going to give you that loan to $500,000 if the contract is for $100,000. They consider on a purchase, they consider the contract, whether it's real estate property or a business that you're buying, they consider the property, the contract is the value on the purchase end. But there's this thing called a refinance. And on the refinance, what happens is if I keep this, I go buy this company for $100,000, okay? And the bank gives me $90,000 of that, okay? So now the bank's giving me $90,000. The truth is the company is worth $500,000. I just got it because old man Gibson down the road's ready to retire and he just needed $100,000 to get the hell out from under his print shop or whatever. So 6 to 12 months later, depending on the program and the timing and the way that the economy is working with banks, I can go back and I can refinance this and I can say, okay, I want to refinance this business and I want to get my $10,000 back, okay? So you go out and you take a $100,000 loan, they're going to cut you $10K of it back, and now all of a sudden you have a 20% loan to value, so the bank's risk is a lot less on the refinance, and you could get your $10,000 back, or if you wanted to leverage more money against it, you could take a cash out, a cash advance refinance against this as well, okay? Now, let me get creative here with you. This is called a seller second lien. So let's say that the price of this property, this business rather, is $100,000. SBA is going to give you $90,000. Let's say that you're broke and you don't have $10,000. First of all, you shouldn't be buying a business if you don't have any money. But let's just pretend. Okay, but let's just pretend that you're not broke, you've got $10,000, but it's really going to take you about $200,000 to turn this bad boy around. Let me get my calculator over here. To turn this bad boy around and make it a profitable business in a short period of time. So what you can do, there's two ways to do this. What you can do is, number one, let me move this over here. Scenario number one, is you can get a contract between you and the seller for the full $500,000. You've had the business appraised, you've had it evaluated, and you and the appraiser has agreed that it's worth $500,000. That's what you're going to present to the bank. So you, even though you're only going to pay the owner $100,000, you can get a $500,000 loan. Well, 90% of $500,000 is $450,000. So SBA is going to give you $450,000. If you only owe $100,000 to the seller, that's $350,000 that you're getting put back in the bank account from the bank up front if you do a little creative financing here. So now you've got into the business for free, okay? You're going to put $50,000 down, but as soon as you close, you're going to turn around and get $350 back. So you're going to get $400 back. So you're really $350,000 to the good. So now you've got a business that you've stepped into. You've got cash in the bank account. You've got working capital, all from doing this creatively. The second thing that you can do, and this isn't always the case, and sometimes SBA is a little particular on this, but you could buy this company for, let's say, $100,000. Let me go over here to the next slide. In scenario two, you buy the company for $100,000, and the SBA is going to give you $90,000. Well, you can get the seller to carry the other $10,000 to where now this has a first and second lien position on the company, okay? So in the case where SBA gave you $9,000, the seller gave you $10,000, and now you're into this thing for absolutely zero money down, right? Now you can add a zero to that and make it $1 million. You can add a zero to that and make it $10 million. We're just using these small numbers to make it easy here. Typically, the SBA is going to give you, let's say, a 12 to 15% interest rate right now. That's what they're running right now on these 7A loans. You might pay the seller at $10,000 a 20% interest rate. but it's a much smaller 20% interest on 10 grand is really not that much money, especially if you space it out over the course of 10 to 30 years. The reason why I tell you this is because just because the bank says, and in this case SBA says, we're only going to give you 90%, doesn't mean that you can't get money back. It doesn't mean that you have to have money out of pocket. It doesn't mean you can't get creative and get the seller to carry some creative financing for you as well. When we get to the real estate side, I'll tell you about some really creative deals that I've done on the real estate side that'll actually blow your mind. Okay? Making sense to everybody? If you got questions, ask down in the comments section, the chat. Taylor will get you taken care of. So here are the requirements to make your company or to make yourself bankable to where you can go and actually acquire a company with the 7A. They're going to want 2 years tax returns. Now, here's the thing about being an entrepreneur that's tough. We get into being an entrepreneur or a 1099 contractor so that we can minimize our taxes. I'm going through an audit right now. This is my second one in 5 years because I like to minimize my taxes. And the thing is, a lot of times an entrepreneur writes everything off and shows a net loss so that they don't have to pay taxes, or they show the minimum amount. The SBA is going to want to look at your tax returns and make sure that you have money left over at the end of the year, that you're running a profitable business. Why would they give you a loan to go acquire another business when you're running this business that you currently have at a loss? So really what you're looking for is your first 3 to 5 years in business, you can take a loss. You can write off everything, startup expenses. If they start looking at you from year 5 to 10, you're going to have to show some sort of profit. Or the banks, even though you might be totally profitable, you might be like me, where I make millions of dollars every year, but I own tens of millions of dollars worth of real estate that offsets that. I own hundreds of thousands of dollars worth of equipment, tractors, trucks, and things that I offset that with. I make different things into different investments into minerals and things of that nature, which allows me to offset it. But they can see my top line and my bottom line, I'm still profitable. I just made investments that allow me to leverage the tax code. So you can get smart like that. And I'm not a financial planner and a tax guy. Like I told you, I'm being audited again. So I'm not going to be giving you tax advice, but I'm telling you, they're looking to see that your business is profitable. In my case, business is profitable, but I make investments that offset those profits so that I don't have to pay them until the end of until an end of a certain period. I'm rolling at 1031 and everything else. Again, I'm not going to get into all of that, but the bank will start looking at you. If you're just writing off all your expenses and you're breaking even at the end of the year, the bank will start to look at you and go, is this guy really good at running a business? Because he's not showing a profit. And the whole point of being in business is to show a profit. So just because you have tax returns, they are going to have to show a profit. But let me tell you a little trick. And you didn't hear this from me, because I'm not licensed to do anything other than drive a car and a motorcycle. I have a motorcycle license. So I'm not financially licensed, full disclosure. This shit could be fucking total bullshit. Just if anybody's ever watching and thinking, well, I tried it and it's Stewman's fault. No, it's not, because I told you it's bullshit. But I'm just saying, you could show a profit and pay your taxes for 2 years and then get the loan and then go back and amend your taxes and then get your money back from the IRS by writing off the things that you need to write off. But you're gonna hear this shit from me because I didn't say it. And I don't know if that's true or not. You know what I'm saying? I'm just you jiving, you drinking what I'm pouring? Okay, cool. The next thing that they're gonna want is 12 months bank statements. And what they're looking for in bank statements is your Pornhub subscriptions, your OnlyFans subscriptions, and then they are going to demoralize you. No, I'm just kidding. But I did get audited in 2020, and they asked me a lot of questions about, well, what is this and what is that? This is none of your fucking business. That's what that is. It wasn't OnlyFans stuff, but it was definitely money spent in dispensaries. I don't smoke anymore. I'm just saying. They're like, damn, they asked for my personal bank statements. Like, damn, you spend a lot of money in dispensaries. Look, I smoke weed. Shit. I don't anymore, but I did back then. But in your bank statements, and by the way, man, when they were looking through my bank statements, I felt like I was naked. Like I'm violated. Like, damn, they just knowing everything I'm spending money on. Like, that's when I started carrying cash. So back to the point here. In your bank statements, they're looking to see what your average monthly deposit is, right? So they add up all your deposits for the month, take that out by 12 years, divide it and add up each one of them out to 12 months rather, and then divide it by 12. That's how they get that number. So they're looking at their average deposit. So I have a lot of people approach me with Closer Capital and they say, man, we make $50,000 a month. And it's like, no. You made $50,000 one month, but you made $10,000 the other 11 months of the year. So if we take, what is that? 110,000 plus, so 160 divided by 12, you make $13,000 a month. Because here's the biggest trick entrepreneurs fall for, right? They make a certain dollar amount one month and they're like, that's my new identity, right? But like if you don't really make that every single month, then they're not going to count that. They're going to average it out over the course of 12 months. And they're making sure that you don't have NSFs, non-sufficient funds, that you're not overdrawing your bank account, that you're not spending every dollar. Again, they're going to look at your bank statements kind of like they look at your tax returns. Is this person spending every single dollar they get, or they got a little bit left over at the end of the month? Because if right now you don't have any left over at the month, how are they going to feel comfortable giving you more when you don't have any room to work right now to get that, okay? So that's what they're going to look at. They're going to look at your profit from your tax returns, your regular deposits. They want your articles of incorporation, which is your LLC docs, your operating agreement, your EIN number and certification with the state. Some states you have to have a business license and a bunch of other stuff. They're going to want all of that as well to make sure it's in standing, it's filled, there's no liens against it, there's no pending lawsuits, there's no judgments against them. Because if you have a pending lawsuit or a judgment against your company that you haven't fulfilled yet, you haven't finished the lawsuit, you haven't paid off the judgment, they're not going to loan you money because the judgment comes first. It's taking first lien position in that company. So they're going to say, until you pay off this judgment of $100,000, or until you pay off this lien on your company for $100,000, we can't give you money because we could lose any money we loan you to this judgment, okay? But let's go back to this where we were talking about $500,000. Let's say you got a $100,000 judgment against your deal. You go borrow $500,000, 90% of that is $450,000. You follow me? You can use some of that money to pay off that judgment, okay? Then they're going to want miscellaneous letters and docs. They're going to want letter of explanation, what you do, how you acquire your customers. They're going to want your business plan. They're going to want a bunch of things like that. And it's different for every business and every industry and every time you go try that, but they're always going to want some shit and you're going to be like, dude, what? You want that? Where am I going to get that from? That's just part of the banking industry. They're always trying to make sure, because what's happening is they're looking and evaluating your business, the business you're buying, your current standing, and they're saying, okay, what's the risk assessment on that? And for us to feel comfortable about the risk, we need these documents, this business plan, these tax returns, this amount of profit, these 12 months bank statements. We need regular deposits in here. We need future contracts. We need to know what's going to come into this business, how they're going to run this business, who they're going to hire, what their payroll is, what their rent roll is, all of that good stuff, all in there so that they can feel warm and fuzzy about it and you can become bankable. 7A rates run between 12 and 18% typically for a 10-year term. And so a few years ago, these rates were 6 to 10%. So right now, the rates are actually a little bit higher than they have been. Of course, that's no secret. If you can get a mortgage, which is about the most secure loan you can take out in America, a personal primary residence mortgage, if those are sitting at 7.5 to 8.5% right now, then you know that the 7A, the risk of buying a business with no recourse, the recourse being on an LLC that you could shut down or bankrupt or get out from under, is going to be about 12 to 18%. But this is 12 to 18% per year, okay? So if you're running a business and at the end of the year you got a 50% margin, your bottom line, your net profits are 50% because you increase the revenue, you decrease the overhead, you minimize your tax. The only three ways you can make money in business: you minimize your tax exposure. Then what happens is, let's say you got a 15% interest rate. Then you've got 35% margin you've still made after you've paid that for the year, right? And again, this is going to be amortized with amortization. It's going to be amortized over 10 years and then blocked down into 10. The easiest way to explain this is blocked down into 10 years, 1 year reign, compound interest, 18% every year, which, is what? 1.5% every month, somewhere around there that you would be paying on a regular basis. And they're typically not simple interest, they're compound interest, meaning that they're interest first, just like the mortgage is on your home, okay? The next type of loan is a cash advance. You can use these to acquire a business. You can use these to put capital and make your business flush with capital. You can use these to just put money into more marketing or money into more inventory, pretty much whatever you want to do with it. And these are very unregulated. SBA 7A loans are regulated by government, right? Like banks and the government involved. Typically, these cash advances come from banks and private lenders, okay? And so they're going to want 3 months bank statements. And just like I explained in the 7A loan, they're going to want to see that you have deposits regularly. They're going to take those 3 months, average them out. So if you make, 15 grand 1 month, 10 grand the next month, 15 grand, they're going to say, okay, it's $50,000 divided by 3. Then he's got $15,000 on average. I think that's the number somewhere. $17,000 on average a month in deposits. Then they're going to say, okay, what's his average monthly withdrawals that come out of this bank account? They're going to want to see that you got money left over, okay? They're going to want to make sure that you're in business for at least 12 months. Now, listen, hardly anybody will fund startups. Now, I told you when I bought this building, I bought it with a brand new LLC, but I'm not a startup, okay? Right? I've been in business for a long time. I just put it in an LLC's name, in a brand new LLC, but I've been in business for a long time. So cash advance, you need to at least be in business for 12 months, and you're going to need your LLC, your articles of incorporation, all of that good stuff. Business license is what I call that. But really, for the most part, that's all you need to get a cash advance. We do them at Closer Capital, and they're usually done within 48 to 72 hours. But here's the thing with a cash advance. They typically come with a 20 to 40% interest rate. And you can typically get them from 6 months to 2, sometimes 3-year terms. So, but the way that it works is this is simple interest. It's not compound interest. So if they charge you 20% on $10,000, that is what, $2,000. So if we use small numbers, you get $10,000, they're charging you $2,000 of that over the course of 12, that $2,000 and $10,000 over the course of 12 to 24 months typically. So it's not as bad as it actually sounds. A credit card loan, then they are charging you that interest is compounding monthly. Cash advance is simple. They usually say, hey, here's what you're paying. You're borrowing $10,000, you owe us $12,000 back. If you're at 40%, you're borrowing $10,000, you owe us $4,000 back. When is the time to take a cash advance? When you've got money in your bank account, when you've got good deposits coming in there. When you can go out there and you're like, look, I can buy this inventory, flip it. I got 100% markup on it minus my operating costs. I can make 60% margin, put 20% in my pocket. Allows me to leverage that money over and over again and scale quicker, okay? But these are typically very short-term loans, 6 months to 2 years, and the cash advance, and they carry a different interest rate, but you can't, here's the thing about borrowing business money. You can't let an interest rate really distract you. I'll tell you a story. And I tell the story all the time. It's one of my favorite stories. But Zig Ziglar gets married, and he goes over to his wife's mother's house for Christmas. And his wife is in the kitchen. She's cooking the ham. She cuts the ends of the ham off, throws them in the trash, puts the pan in the oven. And Zig's like, what are you doing? She goes, well, what do you mean? He goes, you cut the ends of the ham off. That's like the most delicious part. It's how they keep all the flavor in there. What the hell are you doing? She goes, I don't know. It's what my mom taught me to do. He goes to the mom. He goes, why don't you cut the end of the hams off? She goes, well, I don't know. It's what my mom told me to do. So he goes to the grandma. Why you cut the end of the hams off? She goes, I don't know why they cut the end of the ham off, but I was always too poor to own a pan big enough to fit the whole ham in there, so I didn't have a choice, okay? Interest rates work a lot like that. Your dad, he always told you, hey, when you go to the bank, you want to get the lowest interest rate. Hey, it's because his dad told him, the banks will get you on an interest rate. And then his dad told him, the banks will get you on an interest rate. So everybody gets so focused on an interest rate when really the interest rate is just the cost of borrowing money. What you want to get focused on is the profits you can make from that money, is the margins. This is what you're really looking for. One word right here, margin. And the margin is the difference between that 20% interest rate and the 50% profit, which leaves you with a 30% margin in this case. And you say, well, what if I don't have a 30% margin in my business? What if I don't have a 50% margin in my business? There's a way to increase revenue, decrease overhead, minimize taxes. Once you combine those three things together, then you create margins in your business and you can make money off the bank's interest rate. But unless you're selling real estate or stocks or insurance or something like that, typically you're going to have a pretty good sized margin. If you're selling e-com, you're marking your shit up 100, 200%. If you're selling furniture, you're marking up your stuff 100, 200%. If you're selling jewelry, if you're doing construction, you're marking things up, right? And it's all relative. If you're doing construction, you might got a 20% general contractor fee, but you're borrowing the money for the whole project. So it all works out in the wash in the end. If you document your numbers and make sure that you're not just loosely borrowing money, that you can actually afford the payments and see the margin that you make from the payments on there. The next thing is an equipment loan. And like I said earlier, equipment loan really can be anything. This right here, this is equipment. This stage is equipment. This vibe board is equipment. The AC in this building is equipment. This microphone is equipment. These lights are equipment. My truck outside is equipment because we got to haul things back and forth. My wife's car, which we use to take speakers, and we use to haul people, and we use to travel across states when we go and speak at different places and don't take an airplane, is equipment. The tractors at my ranch are equipment. The ATVs at my ranch are equipment. The tools we use to work on things here, they're equipments. The computers, the TVs, all that stuff's equipment because it's equipment that's essential to my business. But here's the cool thing about equipment is it's a secured loan. If I go take out a loan against my skid steer for $100,000, let's just say, then if I don't pay that equipment loan, they come and repo the skid steer. If I paid cash here, which I shouldn't have because I didn't realize back then I could do an equipment loan for it, but for the furniture in this building was like $500,000, right? And that's not counting the artwork and everything else. But the furniture in this building was like $500,000. I could have taken out an equipment loan for that furniture instead of paying cash for it. And if I don't pay the payment, they just come and pick up the furniture and then they sell it. So they might give me anywhere from 80 to 100% loan to value on the equipment, okay? They might give me anywhere from 80% loan to value on furniture. They might just give me 80%. They might work something out with the vendor, so on and so forth. And what happens is they say, okay, now dude didn't make the payment. We're gonna have to sell this furniture on the secondary market. So it's a secured loan in most cases, right? In order to get that, you need 3 months bank statements. They're gonna be looking at the same stuff. You need 12 months in business at least. They're not gonna typically give you equipment loan for startups. However, if it's a secured equipment loan, you might be able to get an equipment loan for your startup if you've been in business for less than 12 months. And then they're gonna want to see your business license. We do equipment loans at Closer Capital for everything, like literally everything. Supplies fall into equipment. If you need shingles, plumbing, pipes, electrical wire, all of that stuff, equipment loans work multiple different ways. But, here's the other cool thing about equipment loans and cash advances is these are loans, which means that they are tax write-off, okay? So if I'm having to pay that back, it's a debt. It's not. So like if I go and I make $100,000, I got to go pay 40% to the IRS at my tax bracket, give or take, 40% to the IRS. So if I go borrow this money and I get so if I go make $100,000, I'm only going to keep 60 of it. If I go borrow 100, yes, I might have to pay $140,000 back if I take it to full term, but at the same time, I actually got the full $100,000. So it was actually worth it because I actually got more cash. So a lot of people don't look at things that way either. They get all caught up on the interest rate. They don't understand the difference between $100,000 borrowed to $100,000 in the bank account. $100,000 earned is really $60,000 in the bank account. Okay, just something to think about. Equipment rates run between 8 and 18%. And it's just the difference of the equipment. The equipment might be 18% on the furniture. And the reason why that works on the furniture, for example, is let's say they gave me 80% loan against my furniture here, and then I paid on it for a year at 18%. And so now they've got 100% of their money, and then they got to repo it. Well, then they've already got 20% equity plus 20% plus 18% of their money. So they feel comfortable loaning money out on that. You can typically borrow from 2 to 6 years. Like when I got my tractor, I financed it through Kubota equipment loans, and I got it for, I'm ag exempt, so I got it for 0% for 4 years. So just to give you an idea, right? But again, we do those equipment loans at Closer Capital. Be more than happy. Taylor can answer any of your questions in the chat. Factoring loans. So what is a factoring loan? I'll give you an idea. Let's say that you join Apex. And Apex Entrepreneurs, we call it Apex 2. Apex Entrepreneur is $10,000. Or if you want to do a 12-month term, it's $1,000. Whoops. It's $1,000 per month for 12 months. So there's a 20% interest rate, essentially, if you want to look at it that way, if we finance it out, right? I'm not selling you Apex. I'm just giving you an example in my business because God knows what you do, right? So let's say that 80% of my customers do the 12-month because it's easier for them to shell out $1,000 a month than it is for them to shell out $10,000 up front, okay? And plus, a lot of people, they come in and they join Apex and they pay, month 2, month 3, month 4, hit a big lick because the program starts to work with them, then they just pay off the remainder of the balance, right? But let's say that I get in a jam and I need money and I've got 50 customers paying me $1,000 a month. That looks like a 7. I write like a doctor, so y'all have to forgive me. Okay, so I got 50 customers paying me $1,000 a month. Well, I can go get a loan, which equals $50,000 a month, right? I can go get a loan for about 80% of this. So if I'm in a jam and I need money and I've shown that I've got good payment, that I run a good company, that I've got 5-star reviews, right? Because they're not going to give you business where a lot of people drop off. We pulled our Stripe reports the other day. We have a 0.3 refund rate in our companies, right? I've been doing this for 14 years, and over the life of the term of 14 years, we have a 0.3 chargeback and refund rate, which means that we help people become successful, right? That the companies that I was talking to said this is the lowest refund chargeback rate they've ever seen in any industry, let alone the high-risk industry that I'm in. But we deliver 100% of the time, right? So if I'm in a jam and I've got $50,000 a month coming in, that's $600,000 a year, right? Because we're going to look at this over 12 months because they owe us on 12 months. They can give me a cash advance of up to 80%, which means that I can get a cash advance of $480,000. Now, listen, yes, I'm losing $120K, the difference between 600 and 480. I'm losing that in my residuals, but I'm getting flush with cash up front to where I can leverage that money to go out there. And so what happens is the factoring company takes over my payments for me. The people go in there and they start servicing the payments. There's 2 ways: they service the payments, or I have to start making the monthly payments to them because I got the 480 cash up front. But now let's say that this 480 allows me to go buy a building, buy equipment, go do what I need to do to buy a bigger stage, whatever the case, to be able to grow my business faster. I'll make up for that 120 down the road because I needed that 480 today to be able to grow to the next level that's going to make me 700-800, so that 120 is not a factor in the first place. So that's how a factoring loan works. In order to do that, they're going to want a minimum of 3 months bank statements. typically, if depending on how long you finance people for, if you finance people for 24 months, if you finance people for 12 months, they're probably going to want that period of statements to see how many of those. They're going to want your, what we call, I call them rent rolls, but what they call factoring rolls, right? So they're going to want to see how many people are on recurring rolls, how many people are on recurring payments. They're going to make sure that you've at least been doing this for 12 months and that you have your business license. Then you're getting a cash advance up front that your clients are paying on the back end. This is one of my favorite type of loans to give to people. We do these at Closer Capital. It's one of my favorite type of loans because then you're not out really any money. You're just taking a hit on the front end so that you get a cash injection and you can grow past that, okay? The next thing is factoring rates are typically 80 to 95%. So I went through and was just looking at getting a factoring loan just to see if I could do it. I ended up not taking it, but they offered me 95%. They said, we'll give you 95% of your contracts. You have such a low refund rate. You have a bunch of 5-star reviews. You have 82,000 clients that have bought from you in the last 14 years, and you have such a low refund rate. We feel comfortable with you. We'll give you 95% of your recurring revenue. And let's say that every month I have $200,000 in recurring revenue, which is $2.4 million. They were going to give me 95% of that. Which is 2.28. So they were going to give me 2.28 million bucks. Like I said, the reason why I didn't go through with that is they weren't basing it on my 20%, so I would have actually lost 25% of our revenue going that way. It just didn't make sense. We don't need the cash injection anyway. I just wanted to see if they would give it to me. So that's how it worked for me, but it might be different for you. You might have something that you need the cash. You don't got a lot of cash on hand, but you got a lot of recurring revenue that comes in every month from whatever it is, factoring loan might be for you. The next one is business credit cards, okay? First of all, you can get a business credit card typically at 0% for 12 months. This means that they might give you a $20,000 to $50,000 credit card line of credit at 0%. Okay, these are my favorite. We do these at Closer Capital too. We have a third-party vendor that we put you through that helps you with this. But obviously, in order to do this, you're going to have to personally back it up, and they're going to require your credit score to be 720 or higher. Now, you can get business credit cards with a less credit score than that, but you're not going to get 0%. You're going to get somewhere between 20 to 40%, okay? So you need a great credit score. You need to be in business at least 6 months. You need a business license. And you want to open a business bank account at the bank. So let's say that Chase, this is how you do this. I'm going to give you some game, okay? This is how you become bankable. Let's say that Chase, you go to whatever website and you see that Chase is offering 0% for 12 months. But you bank at Bank of America, and Bank of America is not offering 0% credit card for 12 months. Well, you're going to go over to Chase and you're going to open a Chase Business Advantage account. And you're going to start making deposits in there. 2, 3 months. You're going to leave a balance in there, a nice size balance in there. Then you're going to go back and you're going to apply at Chase for this 0% for 12 months. And they're going to see that you already have a bank account with them that's getting deposits. So they like that because banks leverage your deposits 10 to 1. For every dollar you put in, they loan out 10, okay? So they like that you're making deposits, and they like that you're doing business with them and that you're in good standing with them. You've got a higher probability of actually getting the lower interest rate than if you have a Bank of America account and you go and apply at Chase. It's not always the case, but more often than not, that's exactly what happens. They say, oh, he's already doing business with us. He's already making regular deposits into this account. We're going to set up a line of credit attached to this bank account. We'll do that for them. And guess what? A business credit card tied to that business account doesn't report on your personal credit. The best way to get this started is to go over to Amex, American Express, and apply for an American Express Platinum Business Card. This is the key, ladies and gentlemen. because I'm telling you, I started my entire business from a platinum credit card. Let me pull this up here. I've been a member since 2012. So 14 years I've been with American Express. I started off with a business platinum card, still use it every day, right? That business platinum card, there's everybody talks about Dun and Bradstreet and shit like that, but I'm gonna be real with you. I've never been anywhere and they're like, well, sir, your Dun and Bradstreet score. I've never fucking heard those words anywhere other than dipshits on the internet my entire life. I'm not knocking it. I'm just saying I ain't never fucking heard it at any bank that I've ever applied for anything, and all the business that I've done, all the loans that I've given, I've never heard anybody go, well, according to your Dun and Bradstreet. I've fucking never heard it, right? And people say this, well, it's gotta be, it's marketing, ladies and gentlemen. Dun and Bradstreet marketed themselves a certain way, but most people don't rely on them. Most banks don't rely on them. It's that simple. So they rely on who you are, and if you are a low enough risk to where they'll loan against your business, because in the beginning, you probably got to personally guarantee some shit. Now, when you personally guarantee some things, that means that it doesn't report on your credit, but if the business fails to pay for it, they can pass a judgment against you because you personally guaranteed it. American Express will do that. And what happens is as you start to build credit with American Express, when you go to the banks, the other banks, Chase, Bank of America, who's ever offering 0%, you can present to them that you've got perfect standing with American Express and that you've been able to pay off those cards because they treat American Express in the eyes of a bank. American Express is like a line of credit because that's what it is. It's a 30-day revolving charge-off. It's a 30-day revolving charge count, which means that at the end of 30 days, you got to pay the thing off. Right? You don't get to carry a balance on American Express. You might be able to these days. They offer it, but in the beginning they don't. So you show that you're paying off. I'm charging 40 grand, paying it off every month. Charging 40 grand, paying it off every month. Then they say, okay, this person's good with credit cards. They already have a business credit card with Amex, which is hard to do every single month. Yes, and you already bank with us. Yes, we'll be more than happy to give you our introductory 0% interest rate on this business credit card. And when you can get money at 0% interest rate, it's not free money, but it's cheap money. It's never free because you got to pay it back. But it doesn't come with interest attached to it. So if I can go get a $20,000 to $50,000 line of credit at 0% for 12 months, then I know that I'm going to have to pay off $1,500 that I pay every month if I get 20 grand goes right to the bottom line. If I got $50,000, then I know that, what is that? Basically 40 to 50 every month that goes right to the bottom line. So if I'm use that $50,000 to make more than $4,250, and look, here's the best thing about this is how many times can I turn this 50K around? How many times can I flip it? If I can pay that $50,000 off every 3 months, then really in a 12-month period, I've got $200,000 in a line of credit because I've been able to flip that shit every 3 months and pay it off. So really, even though they gave me a $50,000 limit, I'm paying it off every 3 months. So really, I've been able to leverage $200,000 at 0% interest. You guys tracking with me on this? They're going to want a business license, business bank account as well. This, if you don't have anything like the business credit card is the greatest place to start because that starts your business credit. Get an American Express, then get a Bank of America or a Chase at 0%. And then, and the way American Express works is it's almost like 0%. There's just an annual fee for the card, right? And so if you start showing that you can handle these credit cards, dude, listen, I got 70 fucking something credit cards. Dave Ramsey is pissed right now, fucking angry, right? But the truth is, here's why I did this. I have Capital One Spark. I got Bank of America. I got Chase. I got American Express. I got Citi. I've got like 4 or 5 cards with each one of these banks. Now, do I use them all? Hell no, I just use American Express. But let me tell you this. If things get wild out there for me, if the economy tanks even worse than it already is, like right now the economy's in the toilet, if it goes through the sewage lines, right, then I'll just run these credit cards up. I got backup money on backup money. I got $500,000 worth of credit cards because I got 70 credit cards that carry anywhere from 10 to 70,000. I think my highest is $95,000 on my Citi card. Man, I can use those to float my business until the economy turns around. I can use those to do whatever, cash advance, all this other stuff. until the economy turns around, right? So once you get your Amex set up, and then you go get a banking 0% set up, then you do that for about 6 to 12 months. I didn't go get 70 cards at once. That's a bad idea. But once they see that I'm able to pay these off, then they go and, hey, well, we'd like to give you another offer. Shit, 0%. I'll roll the balance onto this one. Then I'll pay it off at 0%. I'll roll the balance onto this one, pay it off at 0%. I'm working my way backwards out of credit cards as long as I'm paying them off. Okay? Credit card rates, 0% for 12 months, 26% or higher after the fact, right? Here's the thing with credit cards, man. It's best not to keep a balance on them longer than a month, but in worst case scenario, 3 months. You should never borrow more than you can absolutely pay back in 3 months. Because at 26%, that's roughly 2% a month that you're paying. And in 3 months, you're paying 6%. That starts to add up pretty quick. Then 12 the next 3 months. Then 18. It starts to add up pretty damn quick. So you got to be careful there, okay? A line of credit. It's one of my favorite types of loans. A line of credit is you can get secured line and unsecured. Secured means it is backed by an asset. Unsecured means it is backed by you personally or your business. Okay? And so even unsecured, it's still kind of secure because it's backed by your business. Okay? They will take equity. Typically, you have to sign papers where they take equity in your business. Not all the time. We do, at Closer Capital, we do unsecured lines of credit. We do secured too, but we do unsecured, no recourse, meaning if shit goes to hell in a handbasket and you don't pay it, it doesn't affect your personal credit, right? But here's what happens, the difference between secured and unsecured, okay? Secured is like if I take a line of credit out against this building. Let's assume this building is paid off and I need $1 million and I go borrow money from the bank and I say, listen, give me $1 million and I'll put my building up to secure that $1 million so that if I don't pay it, you got $9 million in equity in this building that you win. You win, okay? Unsecured is me saying, hey, I'm really good with money and I promise to pay you back and I have the ability and the track record to pay you back. I don't have a building, I don't have a car, I don't have anything to give you. You just have to trust me and my track record that I'll pay you back. We do both of those types of loans at Closer Capital, but here's the thing. Let me ask you this, we'll take a poll. Which do you think has a cheaper interest rate? The secured, where it's backed by an asset, or the unsecured, where it's backed by nothing? Right? Of course, the secured. So if you can put up security or leverage a security, you're going to get a lower interest rate. So you need good credit for this, right? We're talking 680 or above in most cases. Especially if you want to get optimal interest rates in an unsecured. You want 12 months in business, 3 months business statement, 1 year tax return, consistent deposits in your bank account. I've already explained how this stuff works over and over again, so I won't go into detail there. But typically, a line of credit is somewhere around 3% a month. Now, why do I tell you that? So we'll say 3 to 6% per month. So let's use some simple terms. You borrow $10,000. At the end of month 1, you owe $10,300. Okay? At the end of month 2, you owe $10,600, assuming you made no payments on it, right? You just paid the minimum. At the end of month 3, you owe $10,900. So you're 3 months in before you're at 9%, almost double-digit interest rates. But the key is if I give you a $10,000 line of credit and you can pay this off every single month in 12 months, really what I give you is $120,000. Okay? But if you take this and you 3% a month and you take the 10 grand and you wait till the end of the year, now you owe $13,600. 36% interest rate, right? So 36 to 72% 12-month carry. But the key with the line of credit is not to just let it fester out there and pay the interest only or pay minimum payments for 12 months. You want to pay it off and flip it as many times as possible. Because let me ask you, does $10,000 sound good? Or does the ability to flip $120,000 sound good? For me, I like the 120, so I'm trying to do that faster. Now, you can add zeros to these and make them bigger numbers, obviously, but that's the way a line of credit works. It's a revolving line of credit, which means as soon as you pay it off, you pay the 10 grand off, or if you only borrow 2 grand, then you're paying 3% the first month, paying, if you only borrow 6 grand, you're paying 3% the next month. You pay it off. There's no interest when it's paid off. Then you can borrow it and flip it again, then borrow it and flip it again. These are great for purchase and inventory. If you're a general contractor, you got to buy roofing shingles. If you're a plumber and you got to buy pipes and toilets. If you're a general contractor and you got to buy supplies and flooring and stuff like that, these lines of credit are great because typically on a construction site or on a roofing job, you're going to be able to flip this shit within 30 to 45 days pretty good. So you're going to be able to carry a low 3 to 6% interest rate and be able to really run that, let's say it's 10 grand in this case, and be able to really run that 10 grand and turn it into 60 grand, turn it into 120 grand because you've been able to do that. Now listen, you can borrow hundreds of thousands of dollars. I'm just using low numbers so that it's easier to comprehend and easier for me to do math on. All right, so now, those are all business loans. Now let's talk about everybody's favorite subject, real estate. Excuse me, allergy season. Real estate is really 6 major loans. There is Fannie Mae, Freddie Mac, the Veterans Association, the Federal Housing Authority, hard money, and then banking land loans, okay? So those are really the 6 categories that the real estate world fits in. There's commercial where you can get it, a building like this as well, but so we'll call it 7. Maybe I should have put the 7th one up there. But basically, that's the gist of it. For Fannie Mae and Freddie Mac, they're very similar, okay? And so Fannie Mae and Freddie Mac offer a 95 to 97%. And look, some lenders even have it as much as 103%, depending on what their banking incentives are. I'm just giving you generalization right now. So if you buy a $100,000 home, primary residence, okay? We're talking primary residence, where you're gonna live, then you buy a $100,000 home, and I know what you're saying, where the fuck I'm gonna find a $100,000 home in the middle of, Durham, Ohio or some shit like that? I just made that up. I don't even know if that's a real city. But I'm just saying, easy numbers here. Then Fannie Mae, Freddie Mac will give you 97% of that, which is $97,000. Whoops. $97,000. All you had to do is come up with $3,000 down. Okay? Fannie Mae and Freddie Mac will allow your sellers to carry 3% of closing cost. So that typically is 1 point origination, 1 point for title. So you'll have to come out of pocket $3,000 plus maybe another $1,500 for taxes and insurance up front. Pretty cheap loan to get into. They want 3 months bank statements, personal bank statements for primary residence, 2 years tax returns, a minimum 620 credit score. The higher the score, the better. Really 640 is what they like to see, but they'll go down to 620 sometimes with exception. No income loss on tax returns. So you got to show a profit. They're looking for that. You have to show a profit on a primary residence. And what they don't like to see are these words right here, declining income. I remember in 2021, I took a loan out against my primary residence. And even though I made more money in 2021 than I made in 20 revenue-wise, I wrote off more shit because I owned more real estate and I had more expenses. And they said, Mr. Stewman, you have declining income. What do you mean? I made 10 million. The year before I made 6 million. What do you mean? They said, well, you have declining income because your profit was less at the end of the year. I said, don't matter. My debt to income ratio, right? DTI, the amount of debt to income, I'll go on that in a minute. My DTI is like 1%. The fuck do you care if I made less money or not? I still made millions. What are you talking about? I'd have my CPA and everybody else write letters. I ended up getting the deal done, but they do not like to see declining income. So if you're a W-2 person and you made less money in 2023 on your W-2 than you made in 2022, could be trouble, okay? Then there's a bunch of disclosures you're gonna have to sign as well. So what is debt to income? Debt to income ratio. So the types of debts that actually show up on a credit report. So that would be credit cards, current mortgage, car payments. Maybe you got an Ashley Furniture. I can't spell for shit today. Maybe you got an Ashley Furniture credit card. Maybe you got child support, because that shows up on credit reports. Maybe you've got alimony. Okay. What doesn't show up is phone payment, utilities, insurance, water bill, personal debt, like you owe your mama money. The bank looks at your debt to income ratio. They count it as a percentage. So if you make $10K a month and your mortgage, car payment, and everything else is $3K a month, right? So groceries don't show up. Okay. You pay $3,000 a month, they're going to say you have a 30% DTI. Okay. Not a UTI. DTI. Okay. 10K, $3,000, all this stuff adds up to $3,000 monthly payment, because they're going to look at your minimum car payment, not what you pay. You might overpay on your car. You might spend a little more on your mortgage so that you're getting ahead. They don't look at that. They look at the minimum. They look at your minimum payment on your credit card, not the balance, the minimum payment. They add all that up. When it comes to Fannie Mae and Freddie Mac, you really want a 38% or less DTI. That's what they're going to look, but they're going to count the new mortgage in there. So whatever mortgage you're buying, that payment gets counted in that debt to income ratio. And man, just writing that down messes with me, because when I did mortgages starting out 20 years ago, if you made $10,000 a month, that was a lot of money. And now knowing that $3,800 is your minimum out of 10 grand to hit 38% DTI, knowing that a $300,000 home is going to run you about $3,800 right now with taxes and insurance on it. Like, what about car payments and everything else, man? What a time to be alive, right? What a time to be alive. Crazy. So that's basically what they're looking at. Right now, you get 7 to 10% interest rate with 3 to 5% down on a primary residence. Now, 7 to 10% interest rate with 20 to 25% down on an investment. So all of this that I taught you so far was based on, let me go back here, was based on a primary residence, something to live in. But let's say you're going to buy an investment property. Well, with an investment property, you're going to need 20 to 25% down, okay? But here's how they help your debt to income ratio. They'll take 75% of market rent on the investment property you're buying and reapply that back as income to where, so let's say you own a primary residence, and then you are going to buy an investment property, but the investment property is $3,000 too, so now you're out of whack on your debt to income ratio. Well, they'll take 75% of whatever the appraiser says the market rent for that property is. So let's say the mortgage payment on the new property is going to be $3,000 a month, but on the appraisal, the market rent is $4,000 a month. They're actually going to take the $4,000 a month. It's called the 10 and 12 rule. Divide it by 75%, and they're only going to count $3,000 of that against you, which means this is a wash. And you're going to cash flow the thing at $1,000 a month. They're not going to count that, though. They're going to say, okay, this is a wash, and then it gets offset because they know within the next 60 to 90 days you're going to write a lease, you're going to rent the property out, you're going to cash flow it. So the 10 and 12 rule is 10 months of rent for 12-month period of time. Okay, because they figure someone gets a 12-month rent, then you move them out. You might have to fix the house up, fix the paint, fix the carpet. You might take 2 months to find a new renter. So they call it the 10 and 12 rule. So this is the beautiful thing is a lot of people think, well, I can't go buy a rental property because my debt to income ratio is going to be too high, right? And never mind the fact that you got to put 20 to 25% down because it's an investment. But they think even if I put $25,000 down on a $100,000 home, and again, just using these numbers, I know those kind of homes don't really exist anywhere. But if I go put $25,000 down on a $100,000 home, I've got that money, but I'm not going to qualify to be able to hit the debt to income ratio requirements for Fannie Mae and Freddie Mac to be able to get optimal interest rates. And so a lot of people end up going hard money on that when they don't have to, because a good loan officer like Taylor knows how to take the 10 and 12 rule and apply 75% of the market rent back to that to decrease your debt to income ratio to where you can still fall in and get a Fannie Mae and Freddie Mac backed loan on an investment property. A lot of loan officers don't know that shit. FHA and VA do primary residence only. They're both government programs. You want 3 months bank statements, 2 years tax return, 620 credit score, no income loss on tax returns, disclosures, and with VA, sometimes they'll go down to 580. A VA primary residence loan, they will give you 100% loan to value, which means you can get in there for free. The sellers can pay up to 6% seller concessions, which means that the sellers, if you buy a house, we'll use round numbers again, you buy a house for 100 grand, the sellers, they owe 60 on the house, you buy it for 100, the sellers can give you, they'll write you a contract for $100,000 plus 6% closing costs, okay, so 6K and closing costs. So you're gonna have 1% origination, 1% title cost, you're probably gonna have 2% in taxes and insurance. So right there, you're looking at 4, but you can basically, because you served our country, you can get into here. Here's what you're gonna need though. You're gonna need a DD 214. Okay, I'm not a military guy, so I don't know exactly what that stands for, but I know what you need that shit. Okay, that means that you have served in the military and you were honorably discharged. If you were dishonorably discharged, just much like owning a gun, you can't get a VA loan. Okay, so your DD 214 says that I have eligibility to purchase using my VA backed loan. But here's the cool thing about VA. Kind of sucks about being in the military if this happens to you, right? But here's the cool thing about the VA. They take care of their people just like they take care of them with the VA hospitals, okay? So on your DD 214, if you are over, I believe it is 20% disabled, they get rid of, so on VA, there's a 1.5% funding fee the first time. It's 3% every time after that. But if you're over 20% disabled, and Taylor, if I'm wrong, tell me, but if you're over 20% disabled, they waive these fees. So there's no funding fees on there. And in the military, pretty easy to get 20% disability. You can be like, my foot's a little messed up. The doctor, you kind of get a doctor a little bit of, hey, hook your boy up. When you get this out there, you get good parking that way, and you get VA access, and then you can get the funding fees knocked off of your VA loan, okay? So if you've served in the military, VA is the cheapest, easiest way to get into a home, because especially if you got 20% or more disability on your DD 214, they'll waive all their fees, okay? FHA works like this. They do 97.5%. Does that sound right? Yes. 97.5% loan to value. Is that right? Or is it 96.5? Taylor? 96.5. Thank you. Sounds like a radio station. I knew I was off. So it's 96.5% loan to value. Okay? So if you're buying a house for $100K, they'll give you $96,500. And FHA typically has somewhere around 1.75% funding fee. Okay? Can't waive it. There's no way to get out from under it. That's mortgage insurance. The thing with VA and FHA, though, is they're going to have, your payment is going to be principal, interest, taxes, insurance, mortgage insurance. But you're going to be able, if you have a 580 credit score and you get a VA or an FHA loan, if you were to get a 580 credit score with Fannie Mae and Freddie Mac, if you could pull it off, you're probably looking at 10%. With FHA and VA, you're probably looking at 8.5%, even though you have a lower credit score, because they're there to assist people that have been in the struggle. They're there to assist people. But because of that and because of the high LTV, they make you carry mortgage insurance. Now, unless you're disabled and through the VA, you don't have to have the mortgage insurance funding fees waived, right? But with FHA, it is absolutely required. So you have, if you have good credit, you might look at an FHA loan and say, okay, this is a low rate, but I got mortgage insurance. And you compare that to Fannie Mae and say, hey, this is a low rate, because Fannie Mae, depending on if you do a 95-15 loan, there's a whole bunch of ways you can slice this, but you need to look at the mortgage insurance cost too. It might be cheaper without apples to apples, Fannie Mae and FHA. It might be, if you have good credit, it might be cheaper to go Fannie Mae because you don't have the funding fee, and the mortgage insurance is a little bit cheaper with FHA than it typically is with Fannie Mae, but you want to look at both options. So if you're calling a loan officer like Taylor and you want to look at a primary residence, FHA and VA are primary residence only, and you want her to look at that, you want to take a look at it and say, okay, well, give me the FHA and the Fannie Mae Freddie Mac version so I can compare apples to apples and make sure what makes sense financially for me in this particular property. Okay? 7 to 10% with 0% down for VA, 3.5% down with FHA. These are both primary residences only. If you buy an investment property and you buy this as your primary residence and you actually plan on doing it as investment property, it is mortgage fraud, highly frowned upon, totally incarceratable. I know people that have been in federal prison behind this shit, so it's not fun to play with the government. Don't listen to these other gurus who are like, you go get an FHA loan with 3.5% down, then you just rent it out. Fuck no. You need to at least move into that bitch for 6 months. You never know. You never know, right? Next up, hard money. Hard money's beautiful, okay? It's real easy. They don't look at your credit. They need you to have at least flipped and at least bought 3 homes in the last 18 months in most cases. But they're looking at a 65 to 70% loan to value on hard money, okay? Hard money is private money. It's not Fannie Mae, it's not Freddie Mac, it's not FHA, it's not VA. It's for investment properties. But here's the cool thing about hard money is this is loan to value, not the value of the contract like the rest of the lenders. So let's say that you find a property that appraises for $100,000, but you got a contract on it for $55,000, okay? Which means that you can get a loan for $65,000, which gives you $10K to do rehab costs on this property. And they'll give you the $10,000 at closing. You can add zeros to that, work yourself backwards to whatever that thing is, and they'll give you the $10,000 at closing. You could find a home that's now worth $100,000, but with a little bit of work is $120,000 that you picked up for $55K. And they'll actually give you 65 to 70%. Let's do 60% of 120. That's $78,000, so minus $55,000. Now you've got $23K coming to you at closing, give or take closing costs, $23K coming to you at closing so that you've got rehab costs. Then, when you sell the property, no prepayment penalty on hard money, you sell the property for $120,000, you owe $78,000. You're looking at a $42,000 profit minus closing costs. So that's the beauty of hard money. It's private money. They're looking at it as loan to value. The lower you can negotiate the price, the more you can add value in with your rehabs. This is great for flips, not great for long-term rentals. But here's what you can do if you plan on rehabbing a property and keeping it as a long-term rental. What'll happen is, let's say you bought this $78,000 loan. It's now worth $120,000. you've got it rented out for $1,500 a month, okay? Then after 6 months, the banks will let you refi it. And after 6 months, they'll refinance you out of the hard money loan at the $78,000. Or if you put, at the $78,000 that you owe, they'll refinance you dollar for dollar out of this at a lower interest rate, okay? After 12 months, they will refi it at full value. And in the state of Texas, and in most states, you can get a cash out refinance for 80%. So that means if it's worth $120,000, then you can actually borrow $96,000 against it, minus your 78. That gives you $18,000 at closing cash back. So after 12 months, you get lower interest. You get 6 months, you can refinance it, cost plus acquisition. What you paid plus you paid in rehab, $78,000. They'll refinance that into a lower rate if you got good credit and everything else. In 12 months, they do it cost to value, right? So it's loan to value. And so you can pull, if you waited 12 months to refinance, so let's say you refinance it in 6 months, and then you refinance it again 6 months after that, because the rates dropped or whatever the case may be, you can actually pull cash out of this thing. And that's the beauty of hard money. So if you want to keep it long term, if not, typically hard money comes with a 6-month term. And here's the breakdown of fees. Typically, we do hard money loans at Closer Capital. We do 2% origination, 12% roughly interest only for 6-month term. So it's amortized over 30 years, but it's a 6-month note, interest only, okay? So 12%, 2% origination, 12% interest only for 6 months. It's not bad. Sometimes it might be 15%, depending on what the market is. Right now, it's about 12%, 2% origination, 12% interest only. You got to pay your own closing costs. So you got title, appraisal, insurance, taxes. Pretty cut and dry. At the end of 6 months, you should have rehabbed it. You should have created value. You should have been able to sell it. Like sometimes you can go, like I took a deal for hard money back in November. I just sold the property about 5 months after picking it up. Sold the property. I didn't do a fucking thing to it but mow the yard, and I made $350,000 off of it and paid off the hard money loan, right? So, but I just bought it to flip. So if you're flipping houses, hard money's your best bet. If you are, because that 12% is annualized, it's not 12% for 6 months, it's 12% annualized, interest only with a 30-year amortization, but a 6-year note because they want their money back pretty damn quick because they're flipping money, okay? 70% LTV, 65, 70% LTV on average. Hard money rate, 12 to 15, interest only, 6-month term. Land loan. I do a lot of these, okay? Land loan, they usually want 60% loan to value first lien position, okay? Right now I'm doing a deal in Oklahoma. The bank, I'm doing a deal for $973,000. I'm gonna give you a real-time scenario here. Bank says out of $973,000, we'll give you 583 of it. So if we do 978 minus 583, that leaves me with 395. Okay? This property is worth 1.5 million that I picked up. Okay? Bank will give me 583. I need to come up with $395,000 down. What if I don't got it? What if I don't feel like putting up that much money? What if I don't have a buyer to take it off my hands that quick and I'm gonna be out 400 grand for a while? This is the beauty of land. So what I did was I got the sellers to carry the second. Okay, I put the bank in first lien position with their 583, and I got the sellers in second lien position at 395. The bank gave it to me at 9% over 30 years, and the sellers gave it to me at 12% interest only for 12 months. I'm flipping this land for $1.5 million, already got a contract on it. So I'm flipping the land for $1.5 million. So I'm literally paying $6K a month for probably 2 months. So it cost me 12 grand to be able to make roughly 5.25, $525,000. Okay? So you can get really creative with land. But let's say that you don't have a seller willing to carry a second because they got a mortgage on it, they need money or whatever else. The bank is going to want 40% down. This is why so many people don't buy land. Why does the bank want 40% down on land? What in the hell? What is their beef with land? Right? It's a cow joke. What is their beef with land? Well, land can't be rented out for very much money. Typically, if you're going to give grazing rights, it's $18 per acre per year. So $18 a year per acre. Farming rights, $7, $8 per acre per year, depending on what state that you're in. But there's no way for most people to cash flow land, so they want the loan to value very low so that they're not out there overextending themselves. But they're going to want 3 months bank statements, 2 years tax returns, at least a 620 credit score, no income loss on your tax returns, first lien position, and the disclosures. Okay? So if you're out there and you see me with all my bunches of acreage and you're like, dude, I need to get like Stewman. It's like, at one point last year we had over 2,000 acres of land. I'm always buying and selling land, just like, not too long ago, I had about $30 million worth of real estate, and now I'm about down to 20. So and I'll work that back up. I'm always buying and selling deals, right? And so the reason why I tell you this is like a lot of people don't get land because it's 40% down. But I just gave you big game right here. I got a deal I'm doing for 103 acres in Oklahoma. It's worth about $4 million. I picked it up for $1.3 million. I go to the seller. The seller owes $500,000 on it. I say, listen, I'm going to give you the $1.3 million, but we're going to write a contract for $2 million. And then I'm going to get the bank to give me 60% of $2 million. You're going to carry the second note, and the difference you're going to give back to me in cash so I can clean this property up, make it presentable so I can sell it. Okay, cool. So typically people that own land have equity in it because they had to put 40% down. And a lot of times land's been passed generation to generation, and eventually a generation shows up and they're like, fuck it. On my personal ranch, I went to the rancher and I said, listen, you want $2.75 million for this place. I'm going to give you 2.5. I'm going to give you $500,000 of it cash up front. And then you're going to carry the other $2 million for 36 months at 0% interest rate, amortized at over 30 years. But really what I'm going to do is I'm going to pay you $21,000 a month. And so at 0% interest, I want every one of these $21,000 payments to go to the bottom line. And in 36 months, you're out from under this thing. You get $500,000 today, and you're going to get 21 grand a month for the next 3 years. Okay, cool. Well, that doesn't add up, right? You're still going to owe me about $500,000 when it's all said and done. Cool, I'll either take over your note with the bank if you have one at the end of 36 months, or I'll refinance you out of this deal. But this is what we're going to do in the meantime. The reason why I did that for 3 years is I wanted to hit those 0% and make those big chunks as much as I could over the next 3 years so that if I don't have the money to just go pay it off in the end of 3 years, or if there's a better opportunity for me somewhere else, I can just refinance at 10, 20% loan to value, and I got a hell of a deal for 3 years. And then I'm carrying the rest of it at a very small price. And I'll be used to paying 21 grand a month anyway, so I'll pay that off pretty quick as well. Because for me, I buy and sell land all the time, but the Caddo Ridge Ranch is legacy land, so I expect to keep it and pass it down to my children. The pecans that we give there, the grazing rights we give on the cattle every year, that more than pays for the taxes with the ag exemption we have on it, so that's legacy land for me. And honestly, it's land where we throw retreats for this business, and I have 7 acres separate that's in my personal name with a house on it that I own in my personal name. It has nothing to do with the ranch, even though their property lines touch. That 7 acres is mine personal with my second home that I bought with a Fannie Mae second home loan. You can get a second home if you qualify for it. There's investment property, primary residence, second home. Second home, they'll do 95% as well. So I got a second home over there that is my second home, my weekend home, like a lake house or a vacation house that I have on 7 acres. So it's separate from my business because the business owns the ranch because we do business there. We cattle, pecans, farming, and then we do our retreats. We do the Caddo Ridge, what the hell is it called? The Ranch Mastermind, all that stuff that we do out there. We do parties. We do, social events and stuff that have to do with business. So we keep that separate from my personal house. So when the IRS comes in here and goes, well, you're treating this ranch as if it's your personal use. No, it's business. In the house, my wife, and the house attached to the ranch is for personal use. So it's Wednesday when I'm recording this. It's date night. Amy's like, where are we going? I already know what she was going to ask. Where are we going for date night tonight? Because it's almost that time. So I didn't realize we'd been up here for a little over 90 minutes. Holy shit. So land is 8 to 12%, 20-year return, 60%, 20-year term, 60% loan to value. Buying commercial property, okay? 2 years business tax returns, 12-month bank statements, property appraisal, rent rolls, and a renovation budget if you're gonna renovate the commercial property. The building rates on a building works, I've already explained all this stuff, so you're starting to pick up with me now, 12 to 15%. Typically, they do a 5-year fixed, which means they amortize it over 20 years. You got 5 years to lock it in, and every 5 years you have to refinance. At least that's the deals that I've seen right now, because the commercial buildings, especially something worth millions and millions of dollars, they don't want to get upside down and they don't want to lock you in for too long. I got 6% on this building 2 years ago. I called my bank the other day and he's like, yeah, dude, rates are 12 to 15% for what you got, man. There ain't no way that you would want to refinance that thing. I said, yes, sir. I'll just wait and hope that we get a different president in office and the economy turns around and I can refinance it in the next 3 years before my 5-year term is up. So now that I've taught you all this, I want to just the benefits of working with us at Closer Capital real quick, and then I'll let you guys go. 25 years in the industry, we help you make wise decisions with your money. So we don't just give you the money and be like, there you go, little buddy. We want to help you make wise decisions. We give you free consulting. We have multiple lenders in our portfolio for both residential, hard money, commercial, SBA. We work with everybody. We are a broker and a middleman that takes care of all the legwork for you. You can go and apply on 15 different websites and 15 different banks, or you can come to us and we'll look at your portfolio, go to one bank, get the deal done because we know what we're doing. We do fast approvals and soft credit checks, which means we only pull your credit after we've made sure that you're approved financially. We'll pull your credit, and then you give us the approval. We'll pull your credit. We'll move from there. It's a soft credit pull, so it drops off your credit report in 90 days. It doesn't affect your score, okay? If you're looking for capital, if you want to have a conversation, you can go apply at closercap.com, or if you're sitting in front of your computer, you can scan that QR code right there. You guys will get a copy of this replay. Give me a couple days to get all of this edited up, things like my wife calling me out of the video and everything else. But I appreciate your time today. Listen, this is what I ask of you for those of you that have made it to the end. If you learned something today, if you feel like you got more of a financial education in the last 90 minutes from me just shooting you straight and teaching you how to be bankable than you've gotten from programs you've paid for, courses you've joined, college classes you attended, high school classes you attended, jobs you worked at, please go post on Facebook and Instagram and just say Stewman. You can take a picture right now and tag me, Hardcore Closer, tag me on Facebook, Ryan Stewman. Just tag me and tell the world, like, this guy's got it figured out. He helped me so much. What a great class. And the people that make comments on there, we'll make sure that we get you guys the link so that you can send it to those people. It would help me out tremendously, just like I hope that I helped you guys today out as well. Thank you for showing up. Thank you for registering. I hope that I gave you a plethora of information to think about on how to make your business bankable and how you can borrow money. And as always, rise above.